Every trader knows the feeling, that rush of adrenaline as you enter a promising trade, the almost immediate validation as the market moves in your favor, your conviction soaring. You're a genius. This is it, the big one. But then, a tiny flicker of doubt, a minor pullback, a whisper of what if, and before you know it, you've hit that sell button, locking in a small profit, breathing a sigh of relief, only to watch in agonizing slow motion as the market continues to surge, hitting your original ambitious target, and then some. That small profit suddenly feels like a monumental loss, a punch to the gut. If you've ever found yourself staring at a chart, replaying a perfectly good trade you exited far too early, then you're in the right place. This isn't just about missed pips or points. It's about a deeply ingrained psychological trap that ensnares even the most seasoned traders. It's a silent killer of trading accounts and confidence. Today, we're diving deep into the why. Why do we snatch pennies when dollars are screaming to be taken? Why do we self-sabotage our best setups? And more importantly, how do we break free from this insidious cycle and finally let our winning trades truly run? Welcome back, fellow traders. Today, we're confronting one of the most frustrating and costly mistakes in trading, the premature exit from a winning position. This isn't a technical flaw in your system. It's a battle fought entirely within your mind, a direct conflict between your primitive brain's programming and the demands of profitable trading. And understanding these internal forces is the first crucial step toward conquering them. Let's dissect the invisible forces driving this self-sabotage. 1. The allure of certainty, the brain's primitive safety switch. You enter the market with a very human desire, safety. When a trade moves into profit, even a small one, it triggers a primal sense of relief. It's tangible, it's real. Your account balance is green. This isn't greed in the traditional sense of wanting more. It's a profound, almost irresistible urge to protect what you've gained, to materialize that success before the unpredictable market, in its ruthless indifference, snatches it away. Your primitive brain doesn't see potential. It sees threat. A winning trade to your brain is a precarious situation. There's an open position, money at risk, and the possibility of that profit vanishing. Closing the trade, even for a small gain, provides instant certainty. It's like finding a small, safe cave during a storm. You grab it, even if a much larger, more comfortable shelter is just around the corner. We prioritize the certainty of a small win over the possibility of a larger one, even when all your analysis shouts otherwise. Think about the last time you were up 2R, then watched it pull back to 1R. Did a cold dread wash over you? Did you slam that exit button, terrified of giving back any profit? Then, in agonizing hindsight, watched it blast off to 5R? That's the allure of certainty playing its cruelest trick. You satisfied your brain's immediate need for safety, but at the cost of exponential growth, at the cost of your strategy's true potential. You protected a small gain, but you destroyed a much larger one. 2. The painful memory, the scars of giving back. Every trader carries scars. The gut-wrenching memory of watching a profitable trade turn sour. You were up big, feeling like a genius, perhaps complacent, only to get stubborn or distracted, and eventually the trade either stopped out at break-even or worse, for a full loss. That trauma, that emotional scar, becomes a powerful silent command in your subconscious. Don't let it happen again. Avoid that pain. Your brain, designed to keep you safe, will go to incredible lengths to prevent future pain. So when a winning trade shows the slightest sign of weakness, that old fear resurfaces with a vengeance. It screams, "This is exactly what happened last time. Get out now." We're not just trading the market, we're trading our past traumas, allowing old wounds to dictate present decisions. This fear is brutally amplified if you've recently endured a string of losing trades. A small winner feels like a desperate lifeline, a psychological balm. You cling to it, unwilling to risk it slipping through your fingers. But this short-term emotional relief is a mirage, leading directly to the long-term erosion of your profitability. 2. The lack of a robust exit strategy, trading blindfolded. While emotions are powerful puppeteers, a significant driver of early exits often becomes a more fundamental, yet equally destructive problem: poorly defined or even non-existent exit strategy. Many traders obsess over entry criteria, meticulously perfecting their setups, indicators, and confirmations. But what happens after you're in the trade? Without a predetermined target, anchored in sound technical analysis, and a clear risk management framework, you are, quite simply, flying blind. Every tick against you feels like a catastrophic threat, every minor pullback an omen of impending disaster. Without a logical, objective why for staying in the trade, the psychological pressures we just discussed become an unmanageable storm. A solid exit strategy isn't just about picking a random profit target. It's about understanding why that target is valid, what specific market conditions would logically invalidate it, and critically, how much volatility or drawdown you're willing to endure before reaching it. If your target is vague, emotional, or arbitrary, your conviction will crumble under the first wave of fear or uncertainty. You are leaving yourself defenseless against your own mind. 4. Impatience in the demand for instant gratification, the modern trader's curse. We live in a world that rewards speed and immediacy. From instant messages to on-demand everything, our brains are increasingly wired for rapid rewards. Trading, paradoxically, often demands the exact opposite, patience. It requires the ability to wait, to let a setup mature, and to allow a good trade to unfold over hours, days, or even weeks. This clash between our modern, impatient conditioning and the deliberate pace of successful trading creates a powerful, relentless internal conflict. When we see a profit, we want it now. The idea of waiting for a larger move, enduring pullbacks, and trusting the process feels almost intolerable. This impatience leads to impulsive decisions, almost invariably culminating in closing a trade far too soon. This is particularly brutal in shorter time frames, where the rapid, almost constant fluctuations can trigger a never-ending cycle of hope and fear. Each candlestick becomes a potential reason to doubt, to exit, to escape the agonizing wait. It makes sticking to a longer-term, more profitable plan an exercise in mental fortitude. 5. Cognitive biases, the unseen saboteurs of your profits. Your brain, a magnificent machine of shortcuts, uses cognitive biases that, while often helpful in daily life, are catastrophic in trading. Loss aversion, the most insidious. Psychologists Daniel Kahneman and Amos Tversky proved that the pain of losing is psychologically twice as powerful as the pleasure of gaining. This means we'll fight harder to avoid a loss than to achieve an equivalent gain. When a trade is profitable, any potential pullback is perceived as a loss of unrealized gains, activating this powerful aversion. We cut winners short to avoid the feeling of losing profit. Anchoring bias. We tend to anchor our expectations to initial profit levels. If you're up 1R, that 1R becomes your mental benchmark. Any move below it feels like losing money, even if the trade is still robustly moving toward a larger, logically defined target. Recency bias. If your last few trades were losers, your brain's recency bias will scream louder to close a current winner early, simply because the recent memory of pain is so strong. You don't want to tempt fate. You just want to feel like a winner, even if it's a small one. Confirmation bias. We seek information that confirms what we want to believe. If you're feeling uneasy about a trade, your brain will subconsciously cherry-pick chart patterns, news headlines, or internal thoughts that justify closing it, even if the overarching technical picture remains strong for a larger move. These biases operate largely below conscious awareness, making them incredibly difficult to identify and counteract without deliberate, consistent effort. They are your brain's way of trying to keep you safe, but in trading, safe often means small profits and ultimately, overall underperformance. 6. Lack of conviction, the trader's imposter syndrome. How much genuine confidence do you truly have in your trading plan and your ability to execute it? If you've meticulously backtested a strategy, know it has a statistical edge, yet still consistently cut trades short, it often stems from a deeper lack of conviction in your own abilities or the robustness of your system. This is a form of imposter syndrome in trading. You might think, this is too easy, it can't be right, or I must have missed something vital. When the market validates your initial thesis, instead of feeling empowered and trusting, you feel suspicious. You fear your good fortune is fleeting,
that you're just getting lucky and that the market is about to expose your inadequacy. This lack of belief can manifest even when every technical indicator, every fundamental factor, every ounce of logic dictates staying in the trade. The insidious inner voice of doubt whispers that you're not good enough, that your system isn't truly robust, leading you to prematurely pull the plug on what could be your biggest winners. You don't trust yourself to deserve the bigger profit. The devastating cost of premature exits, more than just missed money. So, we've explored the why. Now, let's talk about the very real and utterly devastating cost of closing good trades too early. It's not just about the pips or points you leave on the table. It erodes your entire trading psychology and sabotages your long-term profitability. Decimated risk-reward ratio. This is foundational. If you're consistently taking meager 0.5R or 1R profits, but allowing your losing trades
to hit their full 1R, 2R, or even larger stop loss, your risk-reward ratio is utterly destroyed. You need an impossibly high win rate just to break even, let alone achieve true profitability. A truly profitable strategy relies on letting winners run to achieve a positive risk-reward of 2R, 3R, 5R, or even higher. When you cut winners, you gut this core advantage. Eroded confidence and self-trust. Every single time you watch a trade you prematurely closed continue to hit your original target, it chips away at your confidence in your own analysis and, crucially, your ability to stick to a plan. This creates a vicious, self-fulfilling prophecy. You lack confidence, so you exit early, reinforcing the belief that you can't trust yourself to follow through. Increased transaction costs and emotional fatigue. More trades, even small winners, mean more commissions and spreads eating into your capital. Beyond that, the constant monitoring, second-guessing, and the agonizing regret after an early exit lead to significant emotional exhaustion. This can spiral into burnout, impulsive revenge trading, or simply giving up on your trading journey entirely. Failure to capitalize on your edge. If you've spent countless hours developing and backtesting a strategy with a proven statistical edge, cutting your winners short means you are actively undermining the very thing that makes your strategy profitable. You are denying yourself the full compounding benefit of your statistical advantage, essentially throwing away your hard-earned edge. How to conquer the early exit trap. Rewiring your trader brain. Alright, enough of the painful truth. The good news is that this is a conquerable challenge. It requires discipline, ruthless self-awareness, and an unwavering commitment to changing deeply ingrained habits. Here are actionable strategies you can implement right now to rewire your brain and let those winners run. 1. Anchor to a robust, back-tested exit strategy. Plan your exit before entry. This is non-negotiable. Your profit target must be just as meticulously considered and rigorously tested as your entry point. Define objective targets. Use precise technical analysis like key support and resistance levels, Fibonacci extensions, measured moves, previous swing highs or lows, volatility metrics like ATR to identify logical, objective profit targets before you ever click the buy or sell button. These targets must be based on the market's structure, not your emotions. Insist on favorable risk-reward. Ensure your potential profit target offers a significantly favorable risk-reward ratio, for example, a minimum of 1 to 2, ideally 1 to 3 or more. If the chart doesn't present this, do not take the trade, no matter how enticing the entry looks. This forces you to seek trades with inherent room to run. Plan your trade, trade your plan. Write it down. When you enter a trade, explicitly state your entry, stop loss, and target. Make it an ironclad rule. Once the trade is active, you only deviate from this plan under very specific, predefined, and extremely rare circumstances, e.g. a black swan event, a sudden, undeniable shift in high time frame market structure that you've planned for in your rules. Otherwise, your plan is your commander. Implement intelligent trailing stops. Give your trade room to breathe. A well-placed trailing stop can be your most powerful ally in letting winners run, but it must be set intelligently, not impulsively. Avoid tight trailing stops. If your trailing stop is too close to the current price, you will inevitably be stopped out prematurely by normal, healthy market fluctuations. Your trailing stop must allow the market its natural ebb and flow. Anchor to market structure, not just pips. Instead of a fixed number of pips, consider trailing your stop based on evolving market structure. For example, in a strong uptrend, move your stop below the most recent confirmed swing low as the price makes new highs. This keeps you in the trend until it genuinely breaks. Consider partial profit taking with discipline. Some traders choose to take a small portion, like 25 to 50% of the position, off the table once 1R or 2R is hit, simultaneously moving the stop loss to break even on the remaining position. This provides a psychological boost of a guaranteed profit while allowing the rest of the trade to run freely for bigger gains. Crucially, ensure this is part of your back-tested plan, not an emotional impulse. Practice set and forget with strategic check-ins. Once your trade is entered with your predetermined stop loss and target, make a conscious effort to step away from the charts for significant periods. Constant monitoring is an amplifier of emotions and a killer of conviction. Resist the urge to fiddle. Do not adjust your stop loss tighter or move your target closer based on every minor wiggle or every new piece of social media noise. Trust your initial analysis, which was made with a clear head. Schedule deliberate check-ins. If you must monitor, do so at predefined objective intervals, like every few hours, at session close or open, end of day. This drastically reduces impulsive, fear-driven decision-making. Focus on the process, not the P&L. Shift your focus from the constantly fluctuating profit or loss number to whether the market is still behaving in a way that aligns with your original trade thesis. Is the trend intact? Are key levels holding? If yes, then the P&L will take care of itself. Keep a meticulous trading journal, your personal truth teller. This is perhaps the single most powerful tool for self-correction and genuine improvement. Record everything rigorously. Document your exact trade idea, entry, stop loss, target, and critically, your precise reason for exiting. Analyze every early exit. When you exit a trade early, specifically note the underlying emotion or thought process. Was it fear? Impatience? A perceived but ultimately invalid change in market conditions? Be brutally honest with yourself. Review your missed potential. Go back and objectively track what happened after you exited. How much profit did you leave on the table? This objective, undeniable data, compiled over time, will provide powerful, irrefutable evidence of the actual cost of your early exits and build a compelling case for you to change. Embrace the power of probability and statistics. Your big winners pay for everything. Trading is not about being right on every single trade. It's a relentless game of probabilities played out over a series of trades. Understand the bell curve of profitability. Most profitable trading strategies do not boast 100% win rates. They often have moderate win rates, like 40 to 60%, coupled with a few very large winners that more than compensate for all the smaller losses and minor wins. Your few big winners fund your entire year. Internalize this truth. A significant, often surprising portion of your annual profit will come from a small percentage of your trades, the ones you had the conviction and patience to let your run to their full potential. If you consistently cut these trades short, you are effectively gutting the profitability of your entire system. Shift your mindset from individual trade to long series. Stop looking at each trade in isolation with existential dread or exaggerated hope. See it as one single event in a long series where unwavering patience and rigorous adherence to your process will statistically lead to long-term success. Cultivate mindfulness and emotional regulation. This is often dismissed as woo-woo, but it is absolutely fundamental to sustained success. Acknowledge and observe emotions. When you feel that visceral urge to close a profitable trade, pause. Don't fight the fear, the impatience, the craving for certainty. Simply acknowledge them, name them, and observe them as transient internal states. Reevaluate objectively.
Before acting on emotion, ask yourself this critical question. Has anything fundamentally changed in the market structure or my analysis that invalidates my original trade thesis or target? If the answer is an honest no, then the urge to exit is almost certainly purely emotional. Strategic pauses and deep breaths, simple, conscious breathing exercises can quickly calm your nervous system, pulling your brain out of survival mode and back into a more rational, decision-making state. Visualize patience and success. Before entering a trade, or when feeling tempted to exit, take a moment to visualize yourself calmly holding the trade to its target and vividly imagine the feeling of satisfaction and confidence that brings. Start small. Build unshakable confidence. If you're currently overwhelmed by the psychological battle, start by applying these principles with smaller position sizes. Reduced risk, reduced emotion. Trading with less capital drastically reduces the emotional stakes, making it significantly easier to stick to your plan and practice the art of letting trades run. Build empirical proof of concept. As you consistently let these smaller winners hit their full targets, you'll accumulate undeniable empirical evidence that your strategy works and that you can stick to your plan. This gradually built confidence will then naturally and powerfully transfer to larger position sizes. Conclusion: the journey to becoming a patient, profitable trader. Closing good trades too early is a widespread, almost universal affliction in the trading world. It's a ruthless enemy, but it doesn't have to be your story.
This is a battle fought primarily in the mind, against the formidable forces of fear, impatience, and our deeply ingrained cognitive biases. By developing robust, back-tested exit strategies, implementing intelligent trailing stops, practicing set and forget, meticulously journaling your trades, truly understanding the power of probabilities, and cultivating unwavering emotional discipline, you can, piece by agonizing piece, rewire your primitive brain to become a patient, powerful profit taker. Remember, consistent profitability in trading isn't just about finding brilliant entries. It's about mastering your internal state, managing your trades effectively, and, critically, having the profound conviction and disciplined patience to let your winners run. Don't let fear snatch away your hard-earned potential. Trust your analysis, trust your meticulously crafted plan, and let your profits blossom. If you found this video helpful, make sure to like, subscribe, and hit that notification bell so you don't miss our next deep dive into mastering the markets. And let me know in the comments below, what's the biggest winning trade you've ever closed too early, and what did you learn from it? Let's share our experiences and learn together. Until next time, trade smart, trade safe, and for goodness sakes, let those winners run.